to those increased loan payments. Okay? So the construction costs obviously will include materials and direct labor. These are going to be things like the bills that you submit for your loan draws on a monthly basis. Okay? Because very frequently you can be constructing your own asset, but very often you'll hire somebody. You buy a property and you hire somebody to do it for you. So they're going to bill you every month for the materials and the labor that they incur. Right? So that all goes into your cost of construction. That's direct costs. So the question is, again, how to allocate the overhead between normal production and the project. So we have a GAAP approach and a non-GAAP approach to that. So this is the straightforward piece. This is the not so straightforward piece. So one is you would isolate, I think power is a great example, right? You would increase, you would only allocate the increase in your power bill every month to that project. You would say that power bill went up because over our average power bill cost because we're constructing a building, okay, and the equipment is using more power. So that's one possibility. And then you would just not allocate the fixed overhead. You would say, you know what, forget the rent on that building. It's like, it's there anyway. We're not really incrementally incurring any costs, so we're not going to allocate any fixed overhead. That is not GAAP. Okay, GAAP requires that you allocate a portion of the fixed and a portion of the variable. And you'll learn more about this in your cost accounting class. So GAAP requires that we use what's called a full cost approach. So we have to allocate, we use a cost driver, okay, and we allocate fixed costs and variable costs, fixed overhead and variable overhead according to some cost driver. I could get into a whole bunch of detail with this, but I'm going to just keep it really simple. Just know that if you are using GAAP, according to GAAP, you have to use what's called a full cost approach, which means you have to allocate direct materials, direct labor, and overhead that's both fixed and variable. That's what's important for you to understand for this purpose, okay? So you have to use what's called a full cost approach, which incorporates direct materials, direct labor, and overhead. What two types? Fixed and variable overhead have to be added to the price of that asset. Direct labor hours, yeah, direct labor. You can use, there are a whole bunch of different cost drivers, but direct labor is a very common one. The more labor hours you work, the more costs are probably incurred, the more power you're using, the more I'm probably spending my time in the accounting office, working on this project, right? So that's the idea. Direct labor tends to drive costs up, okay? A method of allocating overhead. So what's important here, again, is that you have to understand in your cost of construction for a self-constructed asset to accurately figure out what the price of that asset's going to be, what's going to be on your books for that asset. So if you're constructing a building, you have materials that go into that building, you have labor that goes into constructing that building, but then you also have these overhead costs. And the price of that building is not going to be accurate unless you incorporate those variable costs and those fixed costs that you incur. Okay? So that's the first issue. The second issue is interest capitalization, as I said. So again, the idea is, and I've said this before, the total cost should reflect the company's total investment in that asset. So what's the total that you invested in that asset? The cost on the book should reflect that total investment. Because the idea is that so that building in that movie studio that I worked in, okay? That building that was not yet placed in service, was it earning any revenue for us? And what's the idea behind capitalizing and depreciating things? What's the idea behind it? What principle are we talking about? What is it? Matching principle, right? And what does the matching principle say? We have to match the expenses with the related revenue, right? So that building this property that we purchased, part of it was placed in service, and every month when we paid our mortgage, we were also earning revenue because we were renting out that space for movies, okay? So we're matching for the part placed in service, very simply. We're matching the mortgage payment with the revenue. So there's an expense related to revenue every month. What about the part of the building that was not placed in service? It's not earning revenue, right? So should we have any expense there? Should we be expensing the mortgage interest related to that building if there's no revenue related to it? No. We have to match it in the future when it's placed in service. When it's earning revenue, then we should be expensing things. So the idea is we capitalize all of the items related to that building, okay, that we're constructing. We capitalize all the costs, but we don't depreciate it. We wait and we start depreciating it once it's placed in service and it's earning money for us. Okay, so it satisfies the matching principle. So I hope that starts to make more sense. So again, part of that is interest costs. So instead of expensing those interest costs, the idea is we are going to expense it in the future when we benefit from that building. Does anyone have a question on that concept? I will explain it again. I think that concept can be confusing, but if you think about it, you're trying to satisfy the matching principle. So you say, normally I have a mortgage bill I'm going to get every month and I really have to pay it. Normally I would expense it because I have this property that's part of my operations and it's helping me earn revenue. But now it's just being constructed. It's not earning me any revenue. So we have to kind of put everything on hold. It's like time out. Just capitalize everything related to it. Interest and everything, just capitalize everything and then expense it once it's placed in service. Okay? So we capitalize, interest is one of those things that we capitalize. So again, you only capitalize the interest on assets that are constructed as discrete projects. Okay? So any project that you're working on, so a great example again is this property. It was an 80-acre site, it had multiple buildings. Some of them were placed in service. We didn't capitalize that interest. We only capitalized the interest on the building that was being constructed, that was not yet placed in service. Okay, and we did that only over the period that it was being constructed. You only capitalize interest during the construction period. I've said that. And again, here it just says the same thing. It satisfies the matching principle. Okay, you're going to depreciate later when the asset is providing benefits for you. Okay, an asset is a resource of the firm that's going to benefit the firm in the future. So that building is a resource that's going to benefit you in the future. It's going to help provide you revenue. So you expense when it's actually placed in service, and you're doing that. So getting a little further into this now. Oh, you need me to keep it there another minute? So this is very common too. If you work in real estate, you'll end up seeing things where you have, you'll end up seeing property where you buy a large property. You know, in real estate industry, it's not always like you don't always buy something that's like one building. You buy property that has multiple buildings on it, and some of it is being constructed, some of it's working for you. So this is not an uncommon scenario where you have interest capitalization. Now what we're going to get into is how you do this. Okay, it's how you capitalize this interest. So again, it begins, the capitalization period is when construction begins and you make the first expenditure. Okay? Simple. So what do you do here? So you capitalize the portion of the interest that could have been avoided if you had not been constructing that asset. Okay? So if you start your initial loan and it's giving you $10,000 of interest every month, and then you start doing construction, you take out loan draws, okay, and now your interest is going up to $12,000, $13,000, $14,000. Anything over that $10,000 could have been avoided if you weren't doing construction, okay? So that's the portion that gets capitalized. Okay? It's anything that could have been avoided if the expenditure had not been made. The idea is again,